Hello, and we want to welcome you to our call today with Ed Newton, CPA, CFP, and President of Newton Financial Network. On today's call, Ed is going to discuss the new fiscal cliff and tax issues that will impact you here in 2013. If you're not already a client of Ed's, he's originally from Huntington, West Virginia, has a degree in accounting from Virginia Tech, and a master's degree from Liberty University. Ed landed at Arthur Anderson & Company in their tax department and then began his CPA firm in 1977. He is a CPA and a certified financial planner and is uniquely positioned to help clients achieve and sustain a worry-free retirement. And if you do know him, you know Ed has also been a commercial pilot for a major airline since 1982, and his current weekend routes are to London, England, and Frankfurt, Germany. Ed, good morning and welcome to the call.
Well, good morning, Jeff. Thank you for that. I appreciate it very much, and I want to welcome everyone that's listening. Looks like we've got a good crowd this morning, and I'm not surprised considering that it has to do with the financial cliff and the taxes that result from the issue that we've had with the government lately. For those of you that know me, you may be able to tell my voice is a little bit raspy today. I've got just a little bit of a sinus issue, so if I get quiet for a second, I've just hit the cough button and had to clear my throat or whatever, so I apologize for that. The first thing I want to do and make sure that everyone knows and understands that nothing that I say today has a political slant to it at all. I am equally disappointed in both the Democrats and the Republicans and independents and anybody else that has to do with the Congress or the executive branch at this point with what they've done on the taxes. So please know that I'm not being political when I mention any specific party or office as we go forward today. However, the Congress did on Tuesday last week pull back from the fiscal cliff right at the 13th hour and preserved most of President Bush's tax cuts that were enacted back in 2001, 2003, and they extended many other provisions that had even lapsed already that were supposed to be ended in 2011 that they did extend through 2012 or possibly made permanent. As we go through this morning, I will try very hard not to get in too much of the minutia. However, there is a lot of details and a lot of important information that I think you need to know. So on Tuesday of last week, January 1st at 2 a.m., the Senate passed the bill, and it has come to be called the American Taxpayer Relief Act, or H.R. 8, and later on that day, the House also passed that, and the President signed it into law. So we are looking now at the American Taxpayer Relief Act of 2000, I don't know if they're going to call it 2012 or 2013, but some of the things that were not addressed by the Act and will cause additional taxes to be paid by every single person that has a wage or is self-employed, and that is the temporary lowering of the 4.2% rate on the employee's portion of the Social Security payroll tax. That was not extended, and consequently you will see in your paychecks an additional 2% of your salary is being withheld for Social Security taxes. So that one was not changed at all. For the most part, they retained the Bush-era tax rates, and as you probably heard, that was the biggest discussion of all that they had was the tax rates. And however, they did institute a new top rate, where the top rate before under the Bush-era tax law was 35%. They now raised it to 39.6%. That is for taxable income for taxpayers, single taxpayers making $400,000 or more, or actually it's a taxable income of $400,000 or more. And for married filing jointly, it's $450,000. So married filing jointly didn't get quite as good a deal, if you will, out of this, as did the single individuals. The next, I don't know if it's necessarily most important from a dollar standpoint, but certainly will affect more people, and that is the phase out of the itemized deductions and personal exemptions. For the years 2011 and 2012, there was, or I should say before 2011, there was a phase out that if you made more than a predetermined amount, and I won't bore you with that since it's not applicable anymore, but if you made more than a predetermined amount, you started losing the benefit of some of your personal exemptions as well as some of your itemized deductions. And for 2011 and 12, the law was that that phase out was not in place, so you would get the full extent of your personal exemptions and deductions. Well, for 2013, they have reinstituted that phase out, and basically what they're trying to do there is, again, raise taxes on folks that they consider to be the upper 1 or 2%, depending on who you listen to. And that reinstated phase out has a higher threshold of $250,000 of wages, or adjusted gross income actually, for single individuals, and $300,000 for married taxpayers filing jointly. So if you do have income in excess of $250,000 if you're single, or $300,000 if you're married filing joint, you will lose some, if not all, of the personal exemption and itemized deductions. Another one that is going to affect quite a few people, and this is to the good side, if you will, and that is that there was concern about raising the capital gains and dividends tax rate from 15% to 20%. Congress did see fit to put that 20% rate only on those individuals that are in the top income tax bracket. So the folks that are in the middle brackets or anything other than that 39.6% will still pay income tax on the capital gains and dividends of 15%. Those in the 10 and 15% tax brackets, and that is definitely a lower taxable income, still middle class, but would be on the lower end of the middle class. Those actually have a 0% capital gains tax on capital gains and dividends. If you think you might be in that bracket and you want to talk specifically with me about it to see if it might be a good idea to be able to take advantage of some of the 0% for some of your capital gains, I'd be happy to do that. One of the biggest ones that everyone has been talking about is the alternative minimum tax. And I could spend probably all day speaking about that, and we still wouldn't cover everything that's involved in the alternative minimum tax. It is an extremely complex portion of the tax code. Give you just a little bit of background, that the alternative minimum tax, when it came in, was to be only get just a really, truly a handful of folks that were not paying taxes to pay some taxes at the upper income. And over the years, it just got to bringing in more and more people. Had Congress not acted, the estimates are that roughly 100 million people would have been affected by the alternative minimum tax this year, instead of the 3 million, I think it was 3 million that there were last year. And that's because that AMT exemption was to revert back to $45,000 for married filing joint. So as you can see, I'm confident that everyone that's on this call would have been affected by the alternative minimum tax in that case. Let me back up. I'm sorry. They said that if it had gone back, it would have been 33 million taxpayers would have had to pay alternative minimum tax. So the good news is, under the new law, what they did is they permanently extended the increased alternative minimum tax exemption amounts and indexed it for inflation. So we don't have to worry about every year going forward now having that hanging over our heads, if you will, as to whether we're going to get a bump up for inflation for the alternative minimum tax. Another positive thing that they did was to attack, if you will, the estate and gift tax issue. Again, don't need to go into all the history, but just know that as of January 1st, 2013, the exclusion and exemption for paying estate taxes was to revert to $1 million. They did make effective, as of January 13, the $5 million. In 2012, it was $5.12 million, and they just rounded it down in 13 to $5 million. But that's also indexed for inflation going forward, so that's another positive thing that has happened with that, as well as what they call the estate tax portability election that can be taken by a surviving spouse. Just as try to give you a quick example, if you've got a married couple and the husband dies and he uses, let's say, $2 million of his $5 million exemption, under prior law, the other $3 million would have been, quote unquote, lost. And now an election can be made by the executor that transfers that $3 million of unused estate tax exemption over to the surviving spouse, the wife, so that upon her death, in this example, she would have $8 million that should pass to her heirs estate tax free. So that again was a positive that at least they did the $5 million. They also had several permanent extensions, things that were going year to year more or less, and we always had to wonder whether we were going to get the bump up for the next year or not. The marriage penalty relief, the size of the 15% rate bracket was increased so that there would not be a marriage penalty there. And by marriage penalty, what we mean is that, again, under old law, before we have the marriage penalty relief, two individuals living together as single individuals would pay less tax than a married couple filing a joint return that had the exact same economic circumstances. So they've made that permanent so that we don't have to be concerned with that anymore. Also, for those of you that use child independent care, they have also made that permanent, whereas that was also scheduled to end as well. And let me just go down a couple more of these. Most of them would not affect most everyone, but just if it's something that does affect you, just might perk up your ears and make a note, and we can talk about that at some other point if you'd like to. The exclusion for employer-provided educational assistance has been made permanent, as well as the enhanced rules for student loan deductions. So that's very positive. The student loan deductions was just about to go away. Higher contribution amount and other changes for the Coverdale educational savings accounts. So if you have a Coverdale, that was made permanent as well. Same as permanent for the employer-provided child care. And then we get down to some things that really are very esoteric and would apply to only very few individuals. Another one that is good, that some credits that had expired at the end of 12 that have been made continued, and that is the American Opportunity Tax Credit, which we used to call the qualified tuition and other expenses. So you may have heard of it as the HOPE credit and several others, but now it's the American Opportunity Tax Credit. Some of the things that ended in 2011, at the end of 2011, that they retroactively went back and said, okay, for 2012 and future, we'll also have these benefits, if you will, or deductions available for folks. And that is one of them is the deduction for expenses for secondary and elementary school teachers. There's a provision that expired in 2011 that said teachers could take a $250 above-the-line deduction, so it didn't matter whether they itemized or not. They could take $250 that they spent on classroom supplies and that sort of thing. So that's been reverts back to 2012 now and gives extended through at least 2013. Also, the exclusion from gross income of discharge of qualified principal residence indebtedness. So basically that is if an individual had to return their home to the bank because they were so far underwater on it, there is a provision that difference between the mortgage amount and the fair market value of the house has to be included in income. However, if it's your principal residence, you don't pay tax on that. And that expired in 2011 and has now been continued as well. Most of the others, or another one that may affect some folks, is the mortgage insurance premiums related to a qualified principal residence. And that is, if you put down less than 20%, you have to pay a mortgage insurance, and that is deductible as mortgage interest as well. So that has been reinstated as of January 1st of 2012. Same thing with state and local income taxes. If you live in a taxable state such as North Carolina, South Carolina, Virginia, or most every other state, then it would not apply to you, but those in Tennessee, Florida, Texas, and a few other states where we have clients, you can actually take your sales tax, and that's a computed amount. It's nothing you have to maintain records for. It's a computed amount that we do for you. But you can take the general sales tax as a deduction in lieu of individual income tax, since you don't have that. Same thing with the qualified tuition-related expenses. That's above the line. That had been scheduled to expire, or did expire in 2011, and that has been reinstated as well. Another one that's could be very helpful for some folks that have a philanthropic bent to them and have an IRA and do not itemize deductions, and that's kind of what we're looking at on this particular one. And that is that there's a provision that you can transfer directly from your IRA to a qualified charitable organization. And notice that I did say directly, so it does have to be sent directly from the trustee of your IRA to the charitable organization. That is not included in your income. Now, of course, you don't get the charitable deduction for that, but again, if you're not itemizing, you would have lost that anyway. So again, a lot of rules there that I won't bore you with. That's what we do on a daily basis is to keep up with this, but those distributions that were tax-free and ended in 2011 also go for 2012 and on. The next item is business tax extenders, and I'm not going to go through that list, but just know that if you do have a business and you were getting some special, if you will, deductions or credits, most of those have been extended as well. One of the good things that I did have people this past year were asking me about that I unfortunately had to say, no, I'm sorry, it doesn't apply for 2012. Now I can say I wasn't wrong at the time, but I am wrong now. And that is that these energy tax has been retroactively instituted back to 2012. And those were energy efficient existing homes, alternative fuel vehicle refueling properties, 2 or 3 wheel plug-in electric vehicles, and some biofuel producer credit that probably would not affect anybody on this. And then there's several others. A lot of them have to do with the energy efficient new homes and buying energy efficient appliances and that sort of things. Trying to give you all the good things, if you will, first, and hopefully you haven't just said, boy, this is too much, and gotten off the call or fallen asleep on us here. Now I'm going to tell you a couple of things that were not so good at all for us as individual taxpayers, and that is that There is a new hospital insurance tax on high-income taxpayers. As you may know, the employee portion, that was taken out of your paycheck every payday for the hospital insurance tax, was 1.5%. That's been increased by 0.9% on wages that exceed the threshold amount. That threshold amount is $250,000 in the case of a joint return and $200,000 in a single. Little different numbers if you're filing a separate return from your spouse and head of household. Self-employed taxpayers, same hospital insurance tax applies to the hospital insurance. So if you run a Schedule C and you exceed those threshold amounts, you'll be paying an additional 0.9% on a tax on that as well. The next one is, to me, is a very odd name, but that is what they call it, and supposedly will be used for Medicare, and that is Medicare tax on investment income. So starting January 1st of 13, new code section 1411 imposes a tax on individuals equal to 3.8% of either the lesser of your net investment income for the year or the amount that your adjusted gross income exceeds a threshold amount, and that threshold amount is $250,000 for joint returns and $200,000 for single. Be sure I said that right. Joint, $250,000, single, $200,000. And net investment income does include interest, dividends, annuities, royalties, rents, net gain from the sale of stocks and bonds and that sort of thing. And so it hits pretty much any investment income, including commodities. On the itemized deduction side, not many folks get to take advantage of medical anyway, but those that do, they have put a higher floor. You could deduct anything above 7.5%. That is changing for 2013 to be 10% of your adjusted gross income, unless you're 65, and then it gets postponed for a couple of years. Same thing for the cafeteria plan and flexible spending accounts. Those, the top now is $2,500. That covers the major points that I think that are salient to most of us. I will quickly say that if you have any special circumstances or you think that there's something that may be involved in the new tax law that I haven't covered, please feel free to give us a call here at the office, and we'll be glad to talk with you about that. I have one other tax point that I want to bring up to you. In fact, that just came across my desk this morning, and that is that the Internal Revenue Service has delayed the start of tax season, if you will, until January 30th. And it's going to be even later for some taxpayers. So I'm not going to read this verbatim, but just some of this I will be reading. The IRS announced on Tuesday, and that's today, or excuse me, yesterday, today's Wednesday, sorry, announced yesterday that it plans to open the 2013 filing season and begin processing individual tax returns on January 30th. Excuse me. It says they will be accepting returns on January 30 after updating forms and completing some programming due to the American Tax Relief Act of 2012. They were planning on being able to accept electronic tax returns on the 22nd. However, now they will not accept electronic returns nor begin the processing even of paper returns until January 30th. As I mentioned, some of those taxpayers will not be able to file returns until, these are the IRS's words, February or March. And it will hit quite a few people. The IRS says taxpayers who claim residential energy credits or general business credits or anyone who depreciates property will not be able to start filing on January 30th. So even if you get your records in to us early, we may not be able to file your return until February or even possibly March, and that is also mandated by the IRS. They just won't accept those. And then it does close by saying the IRS will announce a specific date when it will start accepting these forms in the near future. Well, I'm looking at the clock, and it looks like it's only been about 26 minutes, but I feel like I've been talking for 2 or 3 hours over all this dry material, so I apologize for that, but I hope it was enlightening for you. And if nothing else, helps you to realize that you may need to speak with us in a little more detail this year about your tax returns. And for those that are not clients of ours and using someone else, you probably want to do the same thing with your tax preparer. That closes the tax portion of it. I do have something I would like to point out to everyone, and some of you have received emails on it. We're doing something this year in order to try to, quite honestly, to get our workflow a little more even over the time, even though they won't start accepting applications until the 30th. But we've come up with a little promotion that we've got. We're going to give away an iPad this year, 16 gig iPad with the Retina display, so it is the newest iPad that's out. We're going to have a drawing for all of our tax return clients. So if we do your tax return, you'll automatically be entered into the drawing. And there are a couple of ways that you can increase your chances of winning. One, if you bring us all of your tax data before February 28th, you will receive 3 tickets for the drawing. If you bring them in during the month of March, you get 2 tickets. And then for those of you that either procrastinate or unfortunately just can't get your data to us until the first part of April, you get 1 ticket for your drawing. So just trying to encourage people to get their things together quicker. It is easier to do that nowadays with the electronic versions. I know a lot of people have already gotten their W-2s. The mortgage interest statements can be retrieved fairly early as well. So if you can get it to us before February 3rd, we'll give you 3 tickets for the drawing. If you do it during the month of March, you'll get 2 additional tickets. And then in April, you get 1 ticket. So the earlier you bring in your tax return, the more tickets you'll have for the drawing for the iPad with the Retina display. And the retail value on that's $499. So that is that portion of it. I also want to our existing clients, reach out and tell you that in thanks for your referrals, future and past, we're also continuing the referral program we've had in the past, and that is if you refer a client to us and a person to us and they become a client, then you get a $50 credit on your tax return preparation fee as well. So theoretically and hopefully, you could get your tax return prepared for free if you refer enough folks to us. Also, for each person that you refer to us, you will also be given an additional ticket into the iPad drawing. So that summarizes that. Any questions, feel free to give me a call. Give Sarah Beth a call here at the office, 704-552-8689. And with that, Jeff, I think my voice is about gone, so I'll let you take it over to close it up if you would, please.
Okay, Ed, thank you very much. Again, we want to thank everybody for being on the call today, and if you have any questions, give Ed a call at the office, and we'll hope to see you soon. Thanks, Ed. Hope your voice gets better.
Thanks a lot, Jeff. Have a good day.
You too. Bye-bye.
Bye.